We continue with our discussion on Hindalco numbers, and there are some other ratios that are now left to be calculated. We're going to calculate them now and then evaluate some of the data points, try and find answers to some of the questions we have based on the earlier numbers that we have calculated. So let's go ahead and calculate these ones. Current ratio is current assets by current liabilities. So I'm going to do the sum of all the current assets. That's here. And I'm going to divide it by the sum of all the current liabilities, which are on the top. So I'm going to select these, and that's the division, 1.64. Quick ratio will basically do current assets minus inventory. So that's going to take the sum of, in fact, let's put a bracket outside this sum as well. So sum of the current assets, that's here. Sorry, those are the liabilities. So we need to select the assets. They are here, minus the inventories, divided by sum of the current liabilities. Right, so we remove the inventories because that may not be easily offloadable, and so we put that here. Typically, a current ratio of greater than 1 is what textbooks say is good. That may not necessarily be correct in real life, because a lot of the times companies with less receivables and less inventory actually are the ones which do well. So textbooks talk about higher current ratio requirement, but that is not necessarily correct. In the absence, in itself, this number doesn't give us too much of an information. Trend wise, it should be largely stable. If it is stable, then the company is doing what they've been doing all this while. We're going to calculate turnover ratios now. Turnover ratios in general, a lot of the textbooks say different formulas. So inventory turnover, for example, textbooks say cost of goods sold by inventory. In real life, it is difficult to find cost of goods sold because that's not really given. Cost of goods sold should include a combination of raw material cost, purchase cost, etc., and whatever cost has gone in terms of power and fuel in producing those goods, or employee benefit in producing those goods. That segregation is not available to an analyst outside the company, right? So the second part around this is when you're evaluating these ratios, you're trying to compare across firms. Sales gives a better understanding because that can be consistent. You don't have cost of goods sold for all the firms available. And it also kind of, in a slightly more advanced way, affects the company that is making more margins. You're not really creating a benefit for them in this analysis. So we use sales as the number, and that's the consistent data point that gets used across the industry as well. So what's the sales on the P&L? That's going to be here. Let's take net sales and divide it by the respective number. So receivables will be receivables. That's here. That's my receivable turnover ratio. Sales divided by inventory is going to be my inventory turnover ratio, and sales divided by, where's that? Sales divided by payables, which is on the current liabilities side, is going to be my trade payables, is going to be my payable turnover ratio. I can drag it on the right side and basically say that these numbers are kind of, so if you look at these numbers and try and make sense of them, inventory turns roughly 5 times during the year, right? So sales divided by inventory is 5 point something. So effectively, inventory is 1/5 of the sales essentially. Receivables turns about 12 times. Basically, that would mean that we have roughly about 1 month worth of sales outstanding as receivables. You can also calculate what is called as the cash conversion cycle here, where you divide 365 by these ratios that we have calculated here, right? Now, why do we use 365 to divide? Is because 365 days in the year, it essentially tells you how many days of sales will be needed to recover this money that is stuck. So for receivables, for example, in 2011, whatever money was outstanding as receivables, you will need 38 days of sales to recover that money. That number has gone down. So as that number goes down, that's actually good because collection policies seem to be improving, right? Company is receiving money faster. That's actually good. and is paying money later, right? They're paying money later because payable days are increasing, right? Although they've been stable around 52 to 54 for most part, and the last year is what really just increases. And inventory days is how many days worth of inventory is there. So roughly 2 months worth of inventory is held at any point of time, right? So that's what these days tell you. Cash conversion cycle is nothing but receivable days plus inventory days minus payable days. Basically, when do you get the money? How many days of cash do you have to keep? That's improved dramatically over these years, right? Earlier, it's like, when you buy raw material, 69 days will take before you convert it to sales, and then 38 days before you receive that money. And you pay money after 52 days. So you need a credit for 54 days, right? That number has gone down to 31 days now, which is a good sign, right? You are funding operations for smaller period. So that's a good sign that we see, right? So that's the first part that we get. Remember, the second discussion we had earlier was around these return ratios, and we wanted to identify why are these going down, right? Now, when you look at something like return on equity, there is an interesting way to analyze return on equity, right? Let's go down here and let's try and note it down. So what's the formula for return on equity? ROE is equals to net profit divided by equity, right? Now I can make some changes here, and this is what is called as Dupont analysis. I can multiply it with sales by sales. I can do that mathematically and multiply it with assets by assets. What does that give me? I can rearrange these now, so I can get net profit by sales multiplied by sales upon assets, right? Multiplied by assets upon equity, right? This is nothing but my net profit margin. I've already seen this. This is nothing but my asset turnover ratio, sales by assets, correct? How many times is my sales as compared to my assets? The third one that we see is nothing but, if you look at total assets, it's some combination of equity plus debt by equity, right? So in a way, it tells you what is called as the leverage factor, right? It talks about what is the leverage in the firm. This is profitability. This is efficiency. This tells how well you are using your capital structure, or if you're actually increasing ROE by taking a lot of debt. I'll give you another example. Let's actually erase this. Let's say there's a company whose sales is 100 and net profit is 10, right? So that's the sales and this is the net profit. Let's assume the company borrows heavily, and then takes the sales up to, by investing that money in marketing, takes the sales up to 150, and net profit is actually 11. So margins have fallen, right? You will note that your net profit margin has actually fallen a bit, correct? But your equity might have been constant. Maybe your equity was 100. So if you calculate return on equity, it will appear that return on equity is healthier. It will appear that return on equity has increased, right? But that's a short-term thing because you've borrowed heavily and you have to eventually repay this, right? So if you keep increasing debt in the very short run, it might actually increase your return on equity. But in the long run, that's detrimental. We need to find this distinction now, right? So I need to quick calculate my ROE. And so let's just link the net profit margin to the net profit margin number we had. Let's just link asset turnover to net sales by total assets. So let's go to the balance P&L. Net sales is here, divided by total assets on the balance sheet. Application of funds, that's here. And let's divide assets by equity. So on the balance sheet, take assets divided by the net worth or the equity. That's equal to the sum of, right, just a second, sum of these three numbers, right? And we get this. And if I do a product of these three, if I multiply these three numbers, I should get the return on equity that is calculated here. So let's actually change the decimal point a bit and just drag it on the right side, and we can compare. So if we compare, we will get the same numbers: 5.4, 2.2, 0.1, and 4.1. That's the numbers we're getting. Now we can decode and understand what is causing this change. So the first problem all these years when it was falling was the fact that my profitability was going down, net profit margin was going down. Asset turnover was actually more or less constant. It reduced a little bit from 0.85 to 0.7. That tells me I'm becoming less efficient. And assets to equity is going up, which we can correlate with the debt equity ratio and say that probably debt is also going up, right? So if you look at debt equity ratio, we do see that debt is going up here, and so consequently assets by equity is going up. So in fact, debt numbers are going up. That's probably keeping ROI better than what it was. If I were to keep this at 2.92, we will get an even smaller number than what is available here, right? So Control Z, Control Z. So to that extent, I think we are seeing that there is a declining profitability, there is a declining efficiency, there is an increasing debt penetration, which is not so good. Now, the last year that we have seen, the profitability improves. So this is the profitability. This improves. This is the efficiency, right? This probably has slipped a little bit. And this is the leverage that the company has. So leverage has actually improved in the last year because you've repaid some debt. Profitability has improved, and efficiency stays where it was the last year, although over the previous few years it has declined, and that's caused the ROE to jump in the last year, right? If they can sustain this trend, if they can reduce leverage a little bit more and keep increasing profit margins, that's going to be good. It seems to be a revival kind of a thing that's happening with the firm. But if you were to stop here, this was looking disastrous, right? So we need to see whether in the subsequent years, is this just a sudden jump that the company has seen, or is there some more benefit to it, right? I can also calculate a cost structure for the firm. It's good to kind of analyze what is the total cost. So raw material cost will include two headers here, which are purchase of stock in trade and raw material costs. And I'll divide it by the net sales. Net sales here. I'll freeze the net sales number, not the column, but the row. And I put it here, and I then calculate. Actually, I'll need to do that separately for employees because there's a formula there. So employee cost divided by this, and freeze this here. And I can drag this down and drag it on the right side. So in terms of the cost structure, the biggest cost is coming from raw material cost, but that's improved dramatically over the years. So raw material costs are declining, but other costs are jumping up, and power costs are jumping, right? So now I can dig deeper in terms of trying to find out. Other costs are jumping. I can dig deeper in terms of trying to find out why is this happening, right? While that may be beyond the scope of what we are doing right now, at least we are asking the correct question, that why is raw material cost declining? Why is power cost jumping? Why is other expenses jumping? What is this other expense? We can dig deeper in the annual report and try and find out what these other expenses are. Gives us a sense. You will get employee expenses are almost stable, and impairment loss is actually negligible as a percentage of sales. So we don't need to break our head too much over this. But these three we do need to kind of, if we want to do a deeper analysis of a company, we do need to see why these trends are changing, right? Can I find cost of debt, which is the last part of the analysis we'll do about the company? So cost of debt that you see here is interest cost by total debt. So I can take the interest cost from the P&L that's available here and divide it by the debt, right? And debt is available. So let's put a bracket because we know that debt might be two line items. So that's long-term loans plus all kinds of short-term loans that the company has, short-term borrowings, and other financial liabilities, right? This one has to be included. because this is in the newer formats, this is essentially the portion of long-term loans which is maturing in this year, right? So we get the interest cost that comes here, and that will bring us to an interesting analysis as we go along. In some of these years, we find that interest cost is very low. It's about 4%, 3%. That doesn't make sense, right? Because Government of India borrows at 7% or so. It's very unlikely that a company can borrow at less than that and still the company's credit rating should be lower than Government of India in any circumstances. So to that extent, this does not make too much of sense. We do need to infer this from some other data point, which is from the cash flows, right? Now we need to find out what is the cash flow coming in. How do we see this cash flow in a little bit more detail? And for that, let's try and actually decode it from the annual report. So let's open the annual report of this company. And when you look at the data around the annual report, we will find these borrowing terms here. So if you look at the P&L, we will see the finance cost here. This is the last year number, 50484178. Let's look at these numbers here. Do they look the same? 50494178, right? Those are the numbers that we see, correct? Now, interestingly, 2015 might give us a better idea in terms of what is happening. So we'll look at 2015 numbers. Let's look at the cash flow now. So in cash flow, you first add this back, right? Because you are dividing the cash flow into operating and financing activities. So you add back the finance cost. That's what was the 4178 and 5049 number that you were looking at, that got added back to the profit before tax. And then you subtract this number from the financing cost, or cash flow from financial activities, right? When you go to the cash flow from financial activities, finance cost paid, the number is different now. So 4178 becomes 5025. So you've actually paid 5025, but you've accounted 4178. Why is that happening? So you go back a little bit and you look at what's going to be the finance cost here. So there is a note number 33 that we need to look at, right? Look at 4178 and let's go to note number 33 and understand what note number 33 is. When you go to note number 33, that's here, finance cost. Let's look at this. So interest expense was actually 5061 last year. Other borrowing cost, etc., gives you a total number of about 5145. And then there is something called as transfer to capital work in progress. So the actual interest cost was 5145, right? And you actually transferred about 1,000 crore to capital work in progress. What is this now? This concept is nothing but what is called as capitalization of interest. So the company is actually capitalizing some interest. In other words, it is treating the interest cost as a fixed asset, and it is going to depreciate that or amortize that over a period of time, right? Take an example. If you're building a factory worth 1,000 crore and you take a loan to build it and the interest cost is 100 crore, should the fixed cost be counted as 1,000 crore or should it be 1,100 crore? So the accounting policies allow you to capitalize this interest over the useful life of the asset, and so consequently your profit and loss statement underreports interest. This number is underreported for some years, surely. And because this number is underreported for some years, you will see a distorted number in terms of EBIT. Because interest paid is getting underreported, the actual interest payment was higher, right? So let's look at two of these years. In these 2 years, the interest paid number was, in FY15, the interest paid was around 5,100. In FY16, it was also around 5,100 approximately, right? If I were to actually do an EBIT by interest coverage ratio, right? So interest coverage we had calculated was 1.55, 1.13, that was deteriorating, right? Now let's look at this number here. What is the EBIT that we have? So on the P&L, the EBIT that we have is here. That's 2015 divided by what is the current interest cost. That's what we do, right? So it's not 1.55, it's actually 1.27. and that declines further, right? So effectively, because interest cost is higher than what the number is reporting, we might get a distorted interest coverage ratio using just P&L line items. It is very, very important for us to understand that accounting policies sometimes allow companies to account for a different interest cost than what they've actually paid. So interest paid can actually be taken from the cash flow. You can count it for the other years and put that in here. Or you could basically take the notes to accounts and find out what is the exact interest cost and calculate that here. That will give you a truer picture of what the company is up to. That is a very, very important understanding that you need to do. Is there are adjustments needed to these statements as you go along. This number may be underreported, and that's not wrong because the law allows for it. It's fine. It is just that if you're analyzing the company, you need to be careful that this might distort your analysis. You might say 1.55 is not as bad in terms of interest coverage, but the reality is this is not 1.55, this is 1.27, right? For all you know, it could actually turn to be negative at some point of time, if or less than 1 at some point of time, not negative, but less than 1, which is necessarily default territory, right? So whenever you analyze a company, you need to kind of incorporate all these things into the picture. Always remember that what we have done even now is not a very detailed ratio analysis or financial statement analysis. We've calculated the ratios. We have identified the correct questions. Note that we'll end this now with a specific suggestion from our end, which is financial statement analysis is not necessarily about finding the answers to each of these questions, but it is definitely about asking the correct questions. We need to ask, why are trends moving? So we found out about return on equity. Why is return on equity going up or going down? We have left some of these data points around costs with questions to find out why are raw material costs declining or power costs jumping or fuel costs jumping. That may not be in the scope of this particular video to answer these questions, but if you do want to do a detailed analysis, it is important to ask the correct questions and analyze them the correct way. Right? That's it in this particular section of Hindalco's financial statement analysis. Thank you.